Imagine waking up one morning and discovering that the financial institutions you trusted your savings with, banks older than your grandparents, banks with skyscrapers that defined entire city skylines, were suddenly collapsing. Not slowly, not over the course of years, but in a matter of days, sometimes hours. Imagine learning that the very pillars of the global economy had been built on foundations far more fragile than anyone wanted to admit. Now imagine being told that some of these banks, despite making catastrophic decisions, would not be allowed to fail because if they fell, the entire world might fall with them. This is the paradox at the heart of the 2008 banking crisis. Why certain banks could collapse under the weight of their own risk-taking, yet still be considered too important, too interconnected, too colossal to simply let go. And the deeper you look, the more unsettling the mystery becomes. How did we get here? Who allowed it? And why does the same pattern threaten to repeat itself today? To understand why some banks were deemed too big to fail, we have to rewind several decades back to a time when the American financial system was transforming from a conservative, regulated network into a high-speed, profit-hungry machine. For much of the mid-20th century, banking was almost boring. Regulations created after the Great Depression kept risk-taking in check. Banks were restricted in what they could invest in, how large they could grow, and how much danger they could take on with depositors' money. It was stability over spectacle. But beginning in the 1970s and accelerating into the 1990s, a philosophy of deregulation took hold. Banking, politicians argued, needed to be freed to innovate. Markets, they insisted, could police themselves better than any government agency. Step by step, barrier by barrier, the walls built after the Great Depression began to crumble. And in that vacuum, new financial products emerged, complex, sophisticated, and soon wildly profitable. By the early 2000s, the financial system was practically alight with excitement. Banks were no longer simply lenders. They were engineers of financial products so complicated that even insiders often struggled to explain them. At the center of this transformation was the booming housing market. Home prices were rising across the country, fueled by a belief that they could only go up. Banks, hungry for profits, discovered that mortgages, especially risky mortgages, could be packaged into securities, chopped, repackaged, and sold to investors worldwide. The logic was seductive. Spread the risk around enough, and nobody would ever feel the impact of a few defaults. But here was the unspoken twist. The more these exotic products spread, the more interconnected the global financial system became. Risk wasn't disappearing. It was multiplying quietly, invisibly, and dangerously. As the housing bubble inflated, banks grew larger than ever. In fact, by the mid-2000s, a handful of megabanks controlled more of the financial system than at any point in American history. Some were so vast, so enmeshed in everything from derivatives to insurance to global lending, that their collapse would create shockwaves across continents. And yet, these very institutions were taking on the greatest levels of risk. It was a ticking time bomb, disguised as prosperity. Meanwhile, millions of Americans were being approved for mortgages they could not realistically afford. Lending standards, once strict, loosened to the point of absurdity. Stories circulated of individuals receiving home loans without income verification, without documentation, sometimes without even a job. These loans were bundled into mortgage-backed securities, stamped with top credit ratings, and sold as if they were as safe as government bonds. It was as if the entire system had collectively decided to ignore reality, because acknowledging the danger would mean slowing down the profits. But the laws of economics always catch up, and by 2006, cracks began to form. Home prices stopped rising, then they began to fall. Adjustable mortgage rates reset to higher levels. Borrowers defaulted in waves, and the supposedly safe mortgage securities, held by banks around the world, started to lose value. What had once been described as diversified and low risk suddenly looked toxic. At first, Banks tried to reassure the public. They insisted the damage was contained. They insisted the system was stable. But behind the scenes, liquidity was drying up. Trust between financial institutions, a trust that allowed the global system to function, evaporated. Banks relied on short-term borrowing to fund long-term investments. And suddenly, that borrowing became impossible. When a bank cannot borrow, it cannot function. And when a bank is enormous, its inability to function becomes a national crisis. The breaking point arrived in September of 2008, when Lehman Brothers, one of the most storied and powerful financial firms in America, filed for bankruptcy. With over a century of history and astronomical assets, the idea that Lehman could collapse had once been unthinkable. But on that September morning, it did. And it revealed something terrifying. No one truly understood the scale of interconnections running through the global financial system until one of its pillars snapped. Markets convulsed. Credit froze. The Dow Jones suffered one of its largest point drops in history. Money market funds faced unprecedented withdrawals. Ordinary businesses completely unrelated to finance suddenly couldn't access working capital. The world economy stood on the brink of a full-scale meltdown. And this is when the phrase, "too big to fail," entered the public consciousness with force. Government officials, economists, and central bankers concluded that if other megabanks fell the way Lehman did, the consequences would be catastrophic. Some institutions were not simply banks. They were essential arteries in the global economy. Their collapse would not just harm investors, it would threaten the financial stability of nations. So the government stepped in. Through enormous emergency lending programs and bailouts, the United States public effectively became the backstop for the banks. Institutions like AIG, Citigroup, and Bank of America received support measured in hundreds of billions of dollars, written out carefully in government documents, but felt viscerally by a public that suddenly realized it would help pay the bill. To many, it seemed profoundly unjust. Wall Street had made reckless bets, profited enormously, and then received rescue packages when everything fell apart. But to policymakers, the choice was stark: save the banks or risk a collapse far worse than the Great Depression. Even after the bailouts stabilized the system, the fallout was immense. Millions of Americans lost their homes. Millions lost their jobs. Retirement savings were wiped out. Trust in financial institutions plummeted. And yet, many of the banks emerged from the crisis larger than they were before. The irony was painful. The disaster that should have humbled the system instead consolidated power within the most dominant institutions. Attempts to fix the system followed. Regulations like the Dodd-Frank Act sought to limit risk-taking, increase oversight, and prevent another crisis. Banks were required to hold more capital, undergo stress tests, and create living wills to guide potential future bankruptcies. But not all fixes worked as intended. Lobbying weakened key provisions. Some regulations were rolled back. Shadow banking grew outside the reach of oversight. And while certain practices were curtailed, the fundamental incentives that fueled risk-taking remained deeply embedded in the financial system. Perhaps the most unsettling reality is this: the banks considered too big to fail in 2008 are, in many cases, even bigger today. Their balance sheets have grown, their influence has expanded, and new forms of risk, from derivatives tied to corporate debt to digital asset speculation, have emerged in ways reminiscent of the pre-crisis era. Modern parallels are hard to ignore. Household debt is again at record highs. Corporate leverage has soared. Global banks remain interconnected through vast webs of financial products few can fully explain. Studies show that a significant portion of Americans cannot cover a few $100s in emergency expenses, revealing vulnerabilities eerily similar to those before the last crisis. And globally, rising interest rates have exposed weaknesses in everything from real estate markets to pension funds to international lending networks. The story of 2008 is not just history. It is a warning, a reminder, a flashing signal that systems built on excessive confidence, fragile assumptions, and unregulated risk eventually break. And when they do, the consequences fall hardest, not on the architects of the system, but on ordinary people who never asked to be part of the gamble. So, what should we take away from all of this? First, financial systems are always more fragile than they appear. Even in times of apparent prosperity, hidden risks can accumulate beneath the surface, waiting for the slightest shock to unleash cascading failures. The banking system of 2008 looked strong until the moment it wasn't. Second, size and power do not equal stability. In fact, the largest institutions can become the greatest vulnerabilities. When a bank grows so vast that its failure becomes unthinkable, that is precisely the moment when oversight should sharpen, not relax. Too big to fail is not a badge of honor. It is a sign of systemic danger. And third, without structural change, history will repeat itself. Financial crises follow patterns: rising leverage, speculative bubbles, interconnected risks, and eventual collapse. Each generation believes it has engineered a safer system. Each generation proves itself wrong. The question we face now is unsettling. If a crisis of similar scale erupted today, one fueled by even larger banks, faster global capital flows, and new speculative assets, would the world be any more prepared than it was in 2008? That is a question every viewer should consider. Because the story of 2008 is not just about past mistakes. It is about the world we live in right now, and the world we are shaping for the future. If you found this breakdown valuable and want to understand more hidden forces shaping global finance, make sure to like the video, subscribe to the channel, and turn on notifications. There are many more financial mysteries worth uncovering, and the next one might be even more surprising than this.